4 things you never put on a mortgage application. Hi, I'm Amber Coleman with Guild Mortgage. I've been doing loans for 20 years and have approved over 13,000 mortgages. So I've seen a few mistakes in my time. I don't want you to have to make these mistakes. So let's talk about it. Okay, one of the big mistakes I see quite often is when you put yourself down as unmarried, but you're actually married. And sometimes you might think, well, why is that such a problem? I'm getting this loan, I'm paying the mortgage. Why does it matter if I'm married or not married? It matters when you're in a community property state. So right now I'm in Nevada, as you can see behind me, right? I'm right down in Las Vegas. And Nevada is a community property state. There's 7 other community property states in the United States. And when you're married, it's a big deal because what has to happen is your spouse has to either sign on that house or sign off that house, depending on what you and your spouse have decided to do, right? And also when you're doing a government loan, like an FHA VA loan, when you're in a community property state, your credit report has to be pulled for your spouse so that you can debt ratio for what's on your credit and what's on your spouse's credit. I've had people come to me, this happens quite often. I've had people come to me and say, list on their application, because most of the time you're going to fill out an application online, and sometimes we'll go through it over the phone, but the questions still ask, are you married or you're not married? And they'll mark on there unmarried. And then when we're in the underwriting process, it comes up because it usually shows on your tax returns or it shows on your W-2s or your pay stubs. It's going to show somewhere if you're married. And if it does, and you say, well, I'm not married anymore, then the underwriter is going to say, well, give me your divorce decree. And that's where we run into problems. If you can't provide your divorce decree, then we're in a place where, hey, you need to call your spouse because we need to be able to pull credit if you're doing a government loan. Or if you're not doing a government loan, we don't have to pull credit, but your spouse has to sign off at the very end of the process, like acknowledge that you're buying the house and be willing to sign off on what's called a quitclaim deed. Now, if you're in the middle of a divorce or something is not right in your relationship, a separation, and you just aren't on talking terms, and you might be a little mad at each other, I've had a couple of instances where the spouse would not sign a quitclaim deed, would not go there. And divorce proceedings are happening, and now, there's a house in the mix and stuff like that. So it makes it really ugly. And I've honestly had files that were canceled because it wasn't disclosed up front and it was found out in underwriting. So when you're talking about marital status, list it how it is. If you're married, you're listed as married. If you're unmarried, listed as married. And then let's talk about everything. Okay, number 2, never to put on an application, is proposed income. When you're looking at getting qualified for a loan, we're going to look at credit scores, debt to income ratios, assets, right? So debt to income ratios has everything to do with your income and then your liabilities that show up on your credit report. What I've seen a lot of times, what people will do is maybe they make money that's not showing up on paper, and so they put it on the application. So then we're qualifying with that income that doesn't show up on paper. So like, let's say if you're a tip earner and you make more tips in real life than you actually show on your pay stubs, which that happens a lot, especially in Las Vegas, we have to show what shows on the application. Also, what some people will do is they'll say, well, my income is $20 right now, but in 2 months from now, I'm going to make $22 an hour. So I'm going to list that $22 an hour because by the time I own the house, that's what it'll be. We have to count your current income. Whatever shows on your pay stubs right now on a verification of employment, we have to show current income. We can't take, well, I'm supposed to be getting a $2 an hour raise, so just put that down. Because what if you don't get it? That's why we have to show what's happening right now. So proposed income is something that you don't actually have that's showing on paper. Avoid that. Put on the application what your actual income is right now. And then we can talk a game plan. Like if you need higher income in 2 months from now, you're going to get a raise, then let's work a game plan with that, right? But definitely put on your application what shows right now. Number 3 of items never to put on a mortgage application are, remember how we talked about in a mortgage, we're going to look at credit, income, and assets, right? So when we're talking about assets, sometimes people will say, well, I have money put in my mattress, so I'm just going to list it as it's in my bank account when it's not. So money laying around the house, mattress money, whatever it is, we need to be able to see what you actually have in your bank account. if you list money that you have laying around the house, but if you go to deposit that money, we can't always count that money, because how the mortgages work is if you're doing an FHA, a VA, conventional, most of the time, the automated system for those programs that we run to be able to get you approved are going to ask for 60 days worth of assets. So we have to show your assets for 60 days. Any large deposits that show up in your bank account in that 60 days, we have to then prove what those large deposits are. So if you have mattress money and you just are going to put it in your bank account at some point, when you put it in your bank account, it's going to show as a large deposit, and then we won't be able to use it because we can't verify cash. So when we run your application, the automated systems run with how it's listed in there in the paperwork that we received, right? So if you listed the application and say you have $10,000 more than what you actually have in your bank, the automated system might have said, well, I like their assets, so I'm going to approve this. And the minute we take that $10,000 out, it might not approve anymore. And then you're in a situation where you have to kind of run around to try to figure things out. Whatever you have in your bank account, even though you might have the money, if it's not in your bank account or a financial institution, don't put it on the application. Let's talk about it and let's figure out the best plan, the game plan for that cash that you have. If you need it, you might not even need it on the application, but don't list money in your bank account that you truly don't have in your bank account, because it could affect the approval of your loan. Number 4 of things never to say on a mortgage application is to list that you are going to live in that house when your intentions are for that property to be an investment property. This happens quite often. I can't say all the time, but this happens quite often. Because when you're buying a primary residence, the rate is better. The down payment is better. An investment property means that it's a higher risk to the bank. So your down payment is going to be more on those, and your rate is going to be higher on those. So people will want to be able to get into a house as a primary residence versus an investment property. But when you're going through underwriting on that so like whatever you're going to do, you want to be honest about what you're going to do on your loan application, because if you're not truly going to live in that house. So I had one client that said that they were going to move to Vegas, move in that house, and then live there. And the bank actually went and checked on that person, right? They did a grant loan to be able to get that loan. They did all kinds of things to be able to get that loan. And they were planning on moving to Vegas when it came to be, right? Well, they didn't. They didn't move. And then right after they closed that property, they ended up renting the property out. The bank caught them. They went and did an audit on it, which happens. I don't know how often it happens, but it does happen. They did an audit on it. I got a message that said, hey, your client's not living in your house. So I immediately called them and said, hey, what's going on? Like the bank has checked on it. The utilities are turned on in someone else's name. Did you rent that house out? And they said, yeah, we just changed our mind after we bought the house and we just decided to rent it. Well, the bank is then in a situation where they can call your note due, meaning that any money that you just put as a down payment, you just lost it, because the bank is not going to take that house back. So when it comes to occupancy, that's one of the big factors that they find mortgage fraud on a lot, is occupancy. So you want to be truthful in that if you're going to live in that house, you mark that you're going to live in it. But if you're going to use it as an investment property, you mark that this is an investment property or a second home. Like you could do second home as well. But we want to make sure that whatever you're putting on the application is the truth in what you're planning to do with that property. I hope these things helped you to know how to fill out a loan application, to give you a little insight on what a mortgage lender is looking at, what an underwriter is looking at, and why they're looking at it. When we're filling out an application, it is very important to fill everything out exact. But when you do it, when I'm helping my clients, I'm always going to go through, like after you fill out the application, I'm always going to go through each item of the application, and then we can talk about it. That way I can further understand what your needs are, because everybody's different. Sometimes people could live in the city for 4 days a week and then have to travel outward for their job, so like everything's a little bit different. So it's very important that we talk and go through all the items on your application to make sure that everything is right. And the last thing I'd wanted you to do is put you in a bad situation where you have to, like you're going to be in something where, like that one that I talked to you about, where they were going to call her note due because the way that she filled out her application wasn't correct. Her intentions weren't the way that she filled out her application. So So let's talk about it. Let's go through it. If you have any questions, I'm going to leave my information on the screen. I'm also going to put it in the descriptions below. You can call, text, email, and I'm happy to go through questions with you to see what your individual needs are. Let's get you into a house. That's the most important thing. Let's get you into your house, and let's do it the right way. If you like this video and you want to see more videos on information regarding the mortgage industry or the real estate industry, please feel free to subscribe to my page, and I hope you have a great day.